Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1485A, and today's date is January 30th, 2018, and the title of the episode is, The Economy Was Just Nudged into Collapsing. This was done on purpose. Let's get into the economic collapse financial news. Now, we are seeing incredible indicators letting us know that this economy, it is about to come down, and I believe the central bank, Trump, they all know this. They all know that the manipulation that's been going on, well, it's about to end. And when Mnuchin came out and he said, we're going to push for a weak dollar policy, that was done on purpose. That whole thing was done on purpose to nudge the economy. And we're going to be getting into that in a little bit. But what we're seeing right now is things are rapidly falling apart. And normally when this happens, we see it in the housing market, we see it in retail, we see it in the everyday person's life, where you can see it, you can taste it, you can feel it, you know what's going on. And you can see this happening in all different areas. Now, a lot of people believe that this is not happening. A lot of people think that everything is great. And everyone thought the same exact thing prior to 2008. Everyone was like, what are you talking about? I'm buying another house. I'm taking out another loan. I'm buying another car. Everything is fantastic. I don't feel like anything is wrong. Actually, when Obama and McCain were running, McCain was out there saying the economy was incredibly strong. Everything was great. There are no problems whatsoever. And once again, we know that turned out to be a lie. We know that the head of the Fed at the time, Bernanke, he was out there saying that we're not forecasting any type of recession. In the same year, the market came down. So we know that these people lie. We know that they never tell the truth. And this is why we look at the data. This is why we look at what is really going on, not what the government is feeding us, not what the stock market is doing, not what the corporate media tells us. We look at other information. Now, we're looking at housing right now. We know that Case-Shiller, they look at 20 cities. And from these 20 cities, they tell us how the housing market is doing. And according to the latest BLS data, the average hourly wages for all U.S. workers in November rose around 2.5% relative to the previous year, well below the Fed's target of 3.5 to 4.5%. Now, this is kind of weird because the unemployment number is at 4.1%, and they're saying that there's no slack in the economy. And since there's no slack in the economy, it fails to boost wage growth. And this is something where they're looking at it saying this doesn't even make sense. Now, what we are seeing here is that the housing market, the prices of homes, they're going up so quickly that wages are not keeping up whatsoever, which means the everyday person is being left behind. They can't afford these homes. Now remember, they're pushing the bubbles up in these 20 cities. This is being done on purpose to make it look like everything is great. And they're doing this in Seattle, Las Vegas, San Francisco, San Diego, Tampa, Denver, Detroit, Dallas, Los Angeles, New York, Phoenix, Atlanta, Miami, all the cities. And they use these cities to say, look how great everything is. And of course, right now, we are just 1% of the record highs from 2006. Remember when everyone said, oh, good times, they're going to last forever, and we're in 2006, and it was the height of the housing market, and people were renting them out, taking out extra loans. Well, the prices of homes right now, they're 1% shy of the top here. Now, what's very interesting about all of this, in all these different cities that they're telling us, wow, look at the housing prices, because when people hear housing prices, they think, wow, the economy must be doing well. People feel great. I have equity in my home. I feel like I'm making money, but it's only on paper. You don't make anything until you sell the home. Yes, you can take an equity line of credit out on your house, but again, that's debt. You have to pay that back. And when we look at each city, for each individual in these cities, if they wanted to buy a house, they would need an increase in their wages. For example, like Los Angeles, they need a 122% increase in their wages. San Francisco, 107%. New York, 95%. Boston, 81%. And it's all throughout these cities. Right now, the national average is 6%. There's no way that these people can purchase these homes. It's completely impossible. Now, let's add on to that the 30-year fixed mortgage rate, it is increasing. It's surging right now. So, what does that mean? Well, this is coming from Mortgage News Daily. The mortgage rates surged to highest levels in more than 3 years, which means it's going to take those people who are looking for a house, it's going to take them out of the market, which is another problem. We saw this happen during 2006, 2007, when they were raising the rates very, very quickly. It pushed everyone out of the market, and those people who had adjustable rate mortgages, well, they were screwed. And they just left their homes because they knew whatever they locked into in the fixed rate, they couldn't pay it. So they knew they couldn't do anything. And we see right now the Fed, yes, is raising the rates, but they're doing it very, very slowly. But the mortgage rates, they're moving very, very quickly, and they're surging at this point. So we see right now that we have many things happening all at once. And what we're going to see is we're going to see other indicators, and we're going to see them, we're going to look at them, and we're going to see that the economy is ripping itself apart. Actually, online sales didn't do as well as economists thought they were going to do. They were well below expectations. They thought they were going to get like something like a 14 or 15% increase. They got like 11 point something percent increase in online sales. And once again, it wasn't as great as they thought. And again, online sales, it only makes up a small fraction of retail. And we see a lot of stores closing right now, a lot of stores saying that they won't be able to make it. And we know that their debt comes due very, very soon. We also see that the crypto market, they're having their ups and downs. And we know the central banks around the world, they want control of the crypto market. They don't like the crypto market. They don't like a free system that they can't control. They like control and they want control. Facebook right now is looking to ban Bitcoin. Now, it's funny because first they cracked down on fake news, then on Russian ads, now it's cryptos. Now, in a statement posted on its website on Tuesday, which is today, Facebook announced that it has created a new policy that prohibits ads that promote financial products and services that are frequently associated with misleading or deceptive promotional practices such as binary options, initial coin offerings, and cryptocurrency. Now, what they're saying is they don't want people to be scammed. They don't want them to be deceived. We know the central banks are saying that terrorists use cryptocurrencies. And they're pushing the idea, and Facebook is helping because you can hit a lot of people on social media, that cryptocurrencies are bad. And they're doing this on purpose. They want the public to know that cryptocurrencies, if it's not controlled by the central bank, they are just bad. And we can see this is what they're doing. They're demonizing cryptocurrencies on purpose. Now, what are other central banks around the world saying about cryptocurrencies? Well, the U.S. is saying, well, cryptocurrencies, not really that big of a deal. We're looking into our own cryptocurrencies, and there's nothing to worry about. And maybe later on, when it gets bigger or big enough, maybe we'll, take action and, take control of the cryptocurrency market. The European Central Bank has repeatedly warned about the dangers of investing in digital currencies. They're saying that this is being used by terrorists. This is the tulip mania that we saw back in the 17th century bubble in the Netherlands. China is cracking down. China has made it clear that the central bank has full control over cryptocurrencies. The Bank of England, Mark Carney, has cited cryptocurrencies as part of a potential revolution in finance. The central bank started a financial technology accelerator in 2016 aimed at incubating young companies, and they would like to have control over the crypto market. France is out there, and the Bank of France governor is saying, this is just not good at all. It's the dark side. And, terrorists, those people who want to commit crime, they use cryptocurrencies. India, the central bank, is opposed to cryptocurrencies given that they can be channeled for money laundering and terrorist financing. Canada, Carolyn Wilkins, the Bank of Canada, is leading a research on cryptocurrencies and said last November that cryptocurrencies aren't true forms of money. This is really an asset or a security, and so it should be treated that way. And we can see right now they don't want to have anything to do with cryptocurrency if they're not in control. South Korea, as we know, you have to purchase cryptocurrencies in a bank. Russia right now, they have legislation in parliament to create the crypto ruble. It will be taxed. It will be the official cryptocurrency of Russia. Australia's central bank chief criticized cryptocurrencies in a speech, arguing the asset is more likely to appeal to criminals than consumers. And the Bank of International Settlements says we cannot ignore cryptocurrencies. We'll likely have to consider whether it makes sense for them to issue their own digital currency at some point. What they're really saying is, don't use any other cryptocurrencies. They are bad. We are in the process of creating our own. And we will want everyone to use our cryptocurrency. It will be under the control of the central banking system. Because what the Bank of International Settlement is saying is that one option is a currency available to the public with only the central bank able to issue units that would be directly convertible to cash and reserves. So they're pushing the idea that they need to control this. They're trying to demonize it. They're also saying that it's not that important right now because they're trying to make everyone believe that this is something that they need to control. Now, in the end, will they can control it? We don't know as of yet. I like cryptocurrency. I think it should be free and open. I like that the people have control over it. We don't need a central bank controlling this system. We see right now that the US dollar, well, it's plummeting. And if you take the US dollar, we can see it's weakening compared to commodities like cryptocurrency and other national currencies. And economist and money manager Peter Schiff said the following: the US dollar index just broke below 90, which will happen first. Dollar index breaks below 80, gold breaks above 1,500, 10-year treasury yield rises above 4%, or oil prices rise above $100 a barrel. What happens to the stock market and the economy if all four happen this year? Well, we have a major problem. And he's saying that we're in a lot of trouble here. We know that Steve Mnuchin came out and he nudged the economy in a certain direction. And Trump came out and said, no, we want a strong dollar policy. Mnuchin came out and said, we want a weak dollar policy. Steve Mnuchin now is saying that, no, don't worry about it. Yes, we want a strong dollar policy, but I was, taking out of context and things like that. That was done on purpose. It was to push the economy to the next level, where they would make it look like the central bank system had nothing to do with the crash. Now, what we're seeing and what they're pushing right now is to have the system come down. And there's many ways they can do this. They can stop the central banks investing in the stock market. And even though Trump has control of the plunge protection team and all that stuff, it most likely would not help. But that's pretty obvious. They also could nudge it and have people, believe that the dollar is weakening, which they have done. This would be a problem. They could also say, which they've been saying throughout this year, that the economy has been accelerating at such a fast pace because the stock market's going up, because that's what they use as their gauge. They could say that the Fed should now increase rates at a faster pace, like they did back in 2006, 2007. Now, what's very interesting is CNBC, they are saying that the Fed will be forced to raise rates more rapidly than expected because of an accelerating economy, which means as they raise rates and as the mortgage rates go up, the automobile rates go up, and everything else all goes together, people will not be able to afford anything. And as the dollar weakens, we have major problems. Everything starts to fall apart very, very quickly. Now, Chris Hamilton, he came out with another article showing something about personal savings rate. And when you look at the personal savings rate, and every time we had some type of crash, either a depression or a recession, we see two things happening here. We see the personal savings rate at the lowest point that we've ever seen it before. If we go back to 2008, 2007, the personal savings rate was down by it was down around 2.3%. Right now, in the fourth quarter of 2017, the savings rate was around 2.4%. And every time the savings rate drops like this, and the household net worth as a percentage of DPI moves up very, very quickly, well, we have a problem. Now, if we go back in time, we see the household net worth as a percent of DPI was around 650% during 06. At the same time, the savings rate was down around 2.3%. If we go back to 2001, it was around 611% for the household net worth, and the savings rate was down around 3.5%. If we fast forward to 2017, and we're in 2018 right now, but the fourth quarter of 2017, the household net worth as a percentage of DPI is at its highest point we've seen at 685%. Actually, today it's above 700%. And the savings rate is around 2.4%. This spread is huge. And basically what this means is this is just another indicator letting us know that the economy is about to come down. I mean, we're seeing multiple indicators like this that have patterns that we've seen before. And no one can say for sure what comes next. But historically speaking, this scenario has been unequivocally bad for asset prices. Bad like the tide receding beyond the horizon before the impending tsunami, while you are encouraged by experts to go gathering the exposed seashells. And you know what happens once the tsunami tide goes out? It comes in and crashes in hard, and you're there collecting the seashells, and you pretty much are wiped out. This is what's happening right now. This is what's approaching. And we can see that those involved, the central banking system, they're prepared and ready to push the economy like they've been doing off the cliff. And there's reasons why they're doing this. We can see what is happening out in the Middle East. We can see what is happening with the deep state, the cabal, with all these investigations. Everything is happening at once, and they need multiple distractions. They need everything covered up, and this is why this is all being pushed right now. And if you haven't been preparing, I would ramp this up right now, because it looks like we're headed down the rabbit hole, and it does not look good. And we can see they're going to become very, very desperate, and they're going to be pushing anything they possibly can to distract from everything that's been going on. And we know that Q warned this, false flags coming. We know we've been warned. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.